Warren Buffett, the most successful investor in history, is sending a loud and clear warning to the world, but it's not in a letter and it's not in an interview, it's in his actions. He's quietly building the largest corporate cash pile in American history, a financial fortress of staggering size. As of late 2025, Berkshire Hathaway is sitting on over $381 billion in cash and short-term treasuries. This isn't indecision. For an investor who famously says to be greedy when others are fearful, hoarding this much cash is a clear, calculated verdict on the market. He believes there's nothing worth buying. He sees a market that's become detached from reality, a casino fueled by hype where prices defy all logic. He sees an economy groaning under the weight of historic debt, and he's getting ready for the fallout. The signs he's watching aren't hidden, they're in plain sight for anyone who's willing to look. But most people are missing them. Today, I'm going to break down what Warren Buffett sees and why he's so concerned, and what his strategy tells us about protecting our own wealth from what could be the most anticipated correction in a generation. This is not financial advice, this is for education and entertainment purpose only. The stock market is flashing a warning sign that's only appeared twice before in modern history, right before the most two devastating crashes of the last century. Right now, the US stock market is dominated by just a handful of giant companies to a degree we've never ever seen before. The 10 largest stocks in the S&P 500 now account for over 40% of the index's entire value. Let that sink in. The fortune of the entire American stock market are resting on the shoulders of just 10 companies. That isn't a diversification, it's a house of cards. This extreme concentration, a level that makes even the dot-com bubble look tame, is the first and most glaring sign that this bubble is about to burst. And to really get the danger here, you have to understand what this concentration means. An investment in the S&P 500, which people have always seen as a safe, diversified bet on the American economy, has secretly become a massive concentrated wager on a few tech stocks and mega cap stocks. As of late 2025, just 3 companies, Nvidia, Microsoft and Apple, make up over a fifth of the entire index. This created a terrifying weak point. If just one or two of these giants stumbles from a bad earnings report or a regulatory crackdown or a new competitor, they won't just fall alone. They'll pull the entire market down with them. The illusion of safety through diversification is just that, an illusion. Today's S&P 500 isn't your grandfather's stock market. It's a tech-heavy club where a few big names call almost all the shots. This isn't normal. For decades, the 10 top companies usually made up about 15 to 20% of the market. Even during the infamous dot-com bubble in 2000, a time that's now a textbook example of a speculative mania, the concentration in the top 10 stocks peaked at less than 30%. We've blown past the record. The market gains have become dangerously narrow. In fact, even as the index hits new highs, nearly half of the stock market in the S&P 500 are actually down for the year. This is a classic symptom of a sick market where the headlines are hiding a deep underlying weakness. This concentration risk is the heart of the problem. It magnifies every move and creates a dangerous feedback loop. As these giant stocks outperform, all the passive index funds are forced to buy more of them, which pushes their prices even higher and makes them an even bigger part of the index. This cycle pulls in more and more money, concentrating the risk further and further until the music inevitably stops. And when it does, the exits will be way too small for everyone trying to rush out at once. This is the structural weakness that has Warren Buffett so worried, and it's the main reason he's choosing to sit on the sidelines. Warren Buffett's action has always spoken louder than his words, and right now they are screaming. As of the third quarter of 2025, Berkshire Hathaway's cash pile has ballooned to a record-smashing $381 billion. This isn't just a lot of money, it's the biggest corporate war chest in the US history. To put that in perspective, this pile of cash is bigger than the entire economy of countries like Denmark. So why would an investor who built his fortune buying businesses decide to hoard cash instead? Well, the answer is brutally simple. He can't find anything to buy that isn't ridiculously overpriced. In his own words, Buffett has warned about overstretched valuations and a lack of what he calls elephants. Big companies you can buy at a fair price. For value investors like Buffett, the price you pay determines your profit. When prices are this high across the board, the future returns are guaranteed to be low, and the risk of losing your money for good is huge. For Buffett, holding cash isn't an act of fear, it's a strategic position of power. He's not panicking, he's being disciplined. While other investors are caught up in the frenzy, chasing momentum in the market that's priced for perfection, Buffett is patiently waiting. He's been a net seller of stocks for several quarters in a row, a clear signal that he thinks it's a better time to sell than to buy. In just the third quarter of 2025, Berkshire sold about $14 billion more in stocks than it bought. He's even been trimming his stakes in Apple, his his biggest and most successful investment, which suggests that even the market darlings are too expensive for his taste. This is history repeating itself. The last time Buffett built up such a massive cash position was in the run-up to the 2008 financial crisis. While the rest of the market was partying, he was saving his money, and when the crash finally came, he deployed that cash to make legendary deals in companies like Goldman Sachs and General Electric at fire sale prices. His current cash hoard, which is earning a safe and attractive 5% yield from US Treasury bills, isn't just sitting there. It's dry powder, ready to be fired at the moment fear replaces greed and real opportunities pop up from the wreckage. His patience is a powerful message. The risk in today's market just aren't worth the reward. Beyond the market's dangerous concentration, two other key indicators are confirming Buffett's caution: a famous valuation metric he created and the mountain of debt suffocating the economy. So first, let's talk about the Buffett indicator. It's his favorite way to measure market valuation, and it's beautifully simple. It just compares the total value of the US stock market to the country's gross domestic product, GDP. Think of it as a price to sales ratio for the entire country. A ratio of 100% means the stock market is valued at the same level as the country's entire economic output. As of November 2025, the Buffett indicator is flashing bright red, hovering at a level of over 215%. This means the stock market is valued at more than double the size of the entire US economy. Buffett himself has said that a level around 200 is like playing with fire. The only other time this indicator has hit such insane levels were during the peak of the dot-com bubble in 2000 and again in 2021, both of which were followed by major market downturns. This metric is telling us in no uncertain terms that stock prices have completely broken away from the real world economy that's supposed to support them. The second piece of data is even more sobering: the jaw-dropping level of US government debt. The total national debt has now blown past $38 trillion. That number is now significantly larger than the entire US GDP, and it's expected to be over 125% of GDP by the end of 2025. To keep the country running and pay the interest on this colossal debt, the government is backed into a dangerous corner. Since there's no political will to actually cut spending, the path of least resistance is to borrow more and more and eventually for the central bank to print more money. Buffett sees this as a huge long-term threat. He knows that printing money to pay your bills is the classic recipe for runaway inflation. It's a hidden tax that destroys the value of the dollar and eats away at the savings of every American. This combination, an extremely overvalued stock market and a government drowning in debt, creates a dangerously fragile system. High debt makes the economy vulnerable, and when stock valuations are stretched this thin, any small shock can trigger a tidal wave of selling. For anyone thinking but this time is different, history has a chilling lesson for you. The current market, driven by the revolutionary promise of artificial intelligence, looks almost identical to the dot-com bubble of the late 1990s. Back then, the big story was the internet. Gripped by a fear of missing out, investors threw money at any company with .com in its name, whether it had profits, a business plan, or even revenue. Valuations became a joke. Companies with no earnings were given a massive market caps based on metrics like eyeballs. The Nasdaq index shot up 600% between 1995 and its peak in March 2000. Just like today, the market was dangerously concentrated in a few tech darlings like Cisco and Oracle, which were trading at over 120 times their earnings. The belief was simple: the internet had changed the old rules of investing forever. And that sounds familiar. We're hearing the exact same arguments today, just replace internet with AI. The story is that artificial intelligence is so transformative that old school valuations metrics don't apply anymore. This has fueled a mind-boggling rally in a few select AI related stocks, creating the same two-tiered market we saw in the 90s, a small club of mega cap tech stocks soaring to new heights while the rest of the market gets left in the dust. The crash that followed was brutal. When the dot-com bubble finally burst in March 2000, it vaporized over $5 trillion in market value. The Nasdaq lost over 78% of its value over the next 2 years. Many of the high-flying companies that were supposed to change the world simply went bankrupt. Even long-term winner like Amazon saw its stock collapse by 95% before it started its slow climb back. So the lesson is clear: stories don't suspend the laws of financial gravity. Bubbles are always marked by the same things: insane price jumps, wild investor optimism, and the widespread belief that this time is different. We're seeing all of those signs right now, and while AI is without a doubt a world-changing technology, just like the internet was, that doesn't mean that any price is a good price. History shows that when market hype completely disconnects from business reality, a painful correction isn't a question of it, but when. And if you're finding this analysis helpful for cutting through the noise, take a second to subscribe and hit that like button. So if the market is a bubble, what would average investor actually do? Well, the answer is not to panic. Panic leads to emotional decisions, and emotional decisions are how you lose money. The solution is to prepare, and for that we can look right at Warren Buffett's playbook and adapt it for ourselves. First, learn to be patient and start seeing cash as a strategic tool. Buffett's giant cash pile isn't a sign of fear, it's a tool of opportunity. For the rest of us, this means fighting that fear of missing out. It means you don't have to feel pressure to be 100% invested all the time, especially when the market is hitting all-time highs. Building a reasonable cash position does two critical things. It cushions your portfolio during a crash, and it gives you the dry powder to buy great companies when they go on sale. When everyone else is panic selling, you can be the one buying at a deep discount. And second is focus relentlessly on business fundamentals. In a bubble, the market chases stories and hype. Buffett ignores it all. He focuses on the business itself. He looked at companies with a long history of making money, strong balance sheets with very little debt, and a real competitive advantage. In a market obsessed with unprofitable startups and speculative AI plays, an investor who just focuses on profitable, well-run companies is already way ahead of the curve. The question isn't how high can this stock go, is this a great business and can I buy it for a fair price? As Buffett's actions show, the answer to that second part right now is almost always no. Third, and this is critical, make sure you are truly diversified. As we've covered, just owning an S&P 500 index fund doesn't mean you're diversified anymore. It means you're heavily concentrated in a few American tech giants. Real diversification means spreading your money across different asset classes, different countries, and different industries. Buffett himself has been investing billions in Japan, where the company valuations are far more reasonable. For you, this could mean looking at international stock funds, value-focused ETFs, or sectors that aren't caught up in the AI mania, like healthcare or consumer staples. The goal is to make sure that a downturn in one hot sector doesn't blow up your entire portfolio. Don't confuse owning 500 stocks with being diversified when only 10 of them are doing all the work. This three-part strategy, patience, focusing on quality, and true diversification, is how Buffett survives and ultimately thrives through market cycles. It's a defense that protects your money during the storm and an offense that gets you ready to strike when opportunities are everywhere. Thank you for watching, and I hope you subscribe, and I'll see you guys in the next video.